So you could literally buy this for no money down, okay? And then your cash flow will dramatically increase throughout the years as the rents continue to go higher and higher and higher, because this, folks, this is a growth market. Birmingham is a net population gain market, so that rent's going to continue to go up and up and up. So the true value in this is the long-term hold. Welcome to the Investment Properties for Sale show, folks. Saying it's selling at or above list. We are going to provide you guys with complete transparency and education. We take you to the video tour, HoltonWiseTV, giving it to you straight. All right, y'all, today I'm bringing you another opportunity in the Birmingham market. This one right here, we got the Persimmon model. This one is in Montevallo, Alabama. All right, this is a little suburb right there in Birmingham. Now, this is coming to you guys from my friends over at Rent to Retirement. What we have here is going to be a completely brand new construction home available for $265,900. The market rent here, $1,650, and this is going to be brand spanking new, right? So there is no deferred maintenance or any of that stuff you got to worry about, right? So your roof, you know when the first time you got to put $1 into that roof is, folks? Friggin' 30 years from now, okay? Your furnace should give you at least 20 years before you're getting a new one. Hot water tank, probably like 15, although you could upgrade it, get one of those nice tankless joints, okay? And best of all, when you buy from Rent to Retirement, they are able to hook you guys up with the full turnkey set of services, including financing that will allow you to buy this property with no money down, okay? They have builder incentives that they offer to you, and you can utilize that to cover the down payment costs. So you could literally buy this for no money down, okay? And then your cash flow will dramatically increase throughout the years as the rents continue to go higher and higher and higher, because this, folks, this is a growth market. Birmingham is a net population gain market, so that rent's going to continue to go up and up and up. So the true value in this is the long-term hold, right? Or if that is not your fancy and you just have a lot of capital that you need to park somewhere, what you can do is you can use those same builder incentives and you could buy down your interest rate, which is quite nice because as I stand here today talking to you guys, right, interest rates are kind of high. It's a little bit of a bummer, right? We just went through like a solid decade where we all got spoiled, man. We got spoiled. We got fat. We were living in that 3% interest rate market, which is probably never going to happen again. It's never really happened in the previous X amount of years, right? That's just not a normal occurrence, right? It took the largest housing market crash we've ever seen to have those types of interest rate environment, right? So here you have the opportunity when you're working with Rent to Retirement to either go no money down or buy down those rates. And speaking of my friends at Rent to Retirement, what I want to do for you guys now is I want to kind of peel back the curtain on their operation a little bit, kind of peel those layers of the onion back. I want to play some clips for you, right? This is some podcast clips from the CEO, Zach Lemaster, okay? He is the brains of the operation. He's the guy that put this all together, right? And I figure instead of me just trying to talk to you about exactly what he's got going on, I figure it'd be nice for you to get an idea, hear it right from the horse's mouth, like hear Zach discuss kind of why he started the business, kind of his background, also have him discuss some financing and tax implications, just some like real high value, high level stuff that I think you guys need to know. Whether or not you buy this particular model from them in this particular market, I think it's good for you to kind of get an understanding of what they have going on and what their offerings are going to be like. So I want you to take a look at that footage now.
I have a background in healthcare. My wife and I are both optometrists by education. I absolutely loved practicing optometry. I wasn't someone who disliked that. I'm an Air Force captain. I'm a vet now, but I practiced optometry for 7 years in the Air Force and was commissioned as a captain there. That's where I started investing. I bought my first house, was duplex, lived in half, rented out the other half, and just fell in love with real estate. This is probably about 15 years ago at this point. There was really a pivotal moment that changed the trajectory of my wife's, our family, and our trajectory for both business and just wealth in general. And that's where we started to invest out of state. I was stationed in North Dakota at the time, active duty Air Force, And we just thought like, hey, there's got to be better markets out there than just North Dakota. Plus, we were not going to be there forever. So, we started looking at other areas where we could be successful investors and focusing on investing out of state. And it didn't always go well in the beginning, but that was really the birthplace and impetus for Rent to Retirement, which is the nation's leading turnkey real estate company at this point, especially in the build to rent new construction space. So essentially, this company was born because my wife and I were looking for a systematic way to vet markets, to vet teams in those areas, and to build really an approach to being successful investors across the country. And when we started to focus on markets where we saw the best inventory, the best cash flow, the best appreciation, we started to actually pay attention to markets around the country and data points. Our trajectory changed, and we were able to retire ourselves from our professional careers in optometry early in life. Now, fast forward to where we're at today, Rent to Retirement. I mean, you guys are familiar with kind of the turnkey concept, but what we define when we talk about a turnkey property is a property that's either been fully renovated or newly built. About 80% of what we focus on is new construction properties in growing markets that have the best combination of equity, cash flow, and appreciation. And it is quite possible to have all three of those while still investing in A-class areas where you get quality tenants and the homes will appreciate well over time, both in rents and home prices. But when we talk about a turnkey property, first we identify a market that has all the metrics you want to see: economic growth, population growth, diversity of industries, landlord-friendly legislation, low taxes. All these things are very important. And then we go into these markets and we build our local teams and systems in place to be able to access inventory for ourselves and our investors long term. And we have all the pieces in place that are going to help you be a successful investor, from property management, in lenders, specific lenders that we've negotiated special prices for you and offer unique loans, which we're going to talk about tonight. That's part of the reason you're able to get 0% down. And that's not just clickbait. You literally can buy properties, and we're going to walk you through how to do this. Brand new A construction properties with zero money down, and possibly even get money back in your pocket. And I'll explain how that works. But it's a really unique scenario where you can own quality assets and be a very savvy investor. As Adam and Naresh already know, and we didn't put this in the agenda, but I can't help but not talk about it because the time of year that we're in, being an efficient tax investor is extremely important. And we'll go through some interesting things that some of you may know about, or maybe this is the first time you've heard about it, but ways you can write off significant amount of taxes, both from your real estate and your active income, your W-2, whether you're a real estate professional or not. So if you have tax questions, throw those in the chat box. I love talking about tax stuff because our goal every single year, as just individually, my wife and I, is to buy enough real estate to offset our entire taxable income from business, from real estate, from active income, all the things. And we're able to do that every single year strategically. And I'd be glad to talk about some of that. I think it's really important that everyone take out pen and paper right now, because we don't have slides going through the math, but I'm just going to run through the math with you on this stuff. Okay. And I'm going to use simple math and keep it generally broad. But this is a combination of builder incentives and using unique loan structures. Let me set the foundation of like why we're able to access these type of deals and how our company works. So as Naresh said, Rent to Retirement, we form relationships all across the country in markets that we see opportunity in, to bring you the best opportunity regardless of your experience level and your geographic location. So anyone can invest in the best markets to be the most successful investor with all the teams set up in place. Our company really functions two ways. One, we do a lot of in-house new construction that we are personally building. But the majority of what we do, and Chris, I saw you on there. I still got some Cape Coral going there, buddy. So we'll get through it. But our company operates two ways, right? So we build our own stuff, but that's a small minority of what we do. The majority of what we do is actually forming relationships with regional and national builders throughout the country and going to them and negotiating wholesale type of pricing, because as a community, we are purchasing hundreds and thousands of homes across the country. And so we are able to go to some of these national and regional builders and say, we're going to come in like an institution, like a BlackRock, and we're going to buy multiple houses, and we have to commit to that up front. And then we are able to, because of the buying power and the volume, have below market value pricing, wholesale pricing that we pass on to the individual investor. And we still put all the teams with management, lending, insurance, all the things in place. But Our big value add, in addition to helping you build a strategy around investing to do things like maximizing tax benefits, is we are able to pass these wholesale type of pricings from these big builders like D.R. Horton, Toll Brothers, LGI, Lennar, that you would not have access to on your own because you're buying with our community. And we've already done all the research, right? These builders build all across the country, and we get to cherry pick the best inventory in the best markets and then offer wholesale type of pricing to the individual investor. So you don't have to be part of a big institution, right? And we are the first company to be able to do this. We are the first company to take the institutional type of discounts and deals and pass those on to the individual investor. And we're very excited about that. These homes are already completed. Some of them are already leased. Some of them are not leased. These are single family and some small multifamily in multiple different markets. So that's the business model that we operate. Now, how this works is that, we're negotiating these wholesale type of pricing from these builders. That can vary anywhere from generally 5 to 10% below market value pricing. That means on a $300,000 house, if there is a 10% discount on that house, that's $30,000. You could buy that house, and this is where the math is going to, like, if I would encourage you to write this and go through this with me so it makes sense and you have notes on this. On a $300,000 house, if we had a 10% discount on that, and again, it varies 5 to 10%, that means you have $30,000 that is immediately reduced. That builder would sell that retail for $300,000 and is today, that house will appraise at $300,000, but you're able to buy it for $270,000. Right? You get an immediate discount just by being a part of our community. Now, here's where it gets creative and gets better. And I'm going to cover a few of these other slides, but Naresh, stay on this one, I think. And then I'm sure that we'll have a ton of questions. So you have 10% on this $300,000 new construction house in an A-class area somewhere in the Southeast, because there's multiple inventory options and we just look at them with you, right? We have some that are significantly less than this and some that are more expensive. That $30,000 at 10%, you don't have to take as a price reduction. And we're the only people that have access to this exclusive inventory and offering this opportunity to you guys. This is really important stuff. That 10%, you choose, you as the investor get to choose how you want to use that. You can take that price reduction and have immediate equity. Guess what? That will help you burr the property. If you want to burr new construction, you can sell it and actually even probably make some money, because if agent commissions are 5% and you have 10% equity, you possibly could flip that and sell it on the retail market, although most people are looking to cash flow it and hold it. Or you could take that 10% and use it to buy the rate down. So you can buy the rate down into the 3s right now to cash flow the heck out of that on a 30-year fixed loan. Or you could take that 10% and put it back in your pocket, right? If you're putting 20% down on a new construction asset at $300,000, and that $60,000 is a 20% down payment using conventional financing, you can choose, if you want to get $30,000 back. Calculate what that does to your ROI. It skyrockets. All these are still cash flow deals. You have equity because you're putting 20% down, but we're giving you 10% back, right? That will cover half of your down payment. But you can do a combination of these things as well. You're the investor. It's your property. You get to choose how you want to use that 10%, but it's extremely beneficial. And not all properties are 10%. It varies on the market, anywhere from 5 to 10%. Some of the deals that we have that are 5% cash flow better and actually do better than the 10%. But this is where the 0% comes in, okay? And go through some questions, guys, if you have questions on this, because I'm happy to dive deeper into this. So we have 5 new construction inventory all across the country that you can get 5 to 10% discounts on, that you get to use. You don't have to use it as a discount. You can get cash back, buy the rate down, however you want to use it. Your money. And that's because we've negotiated with these national builders because of the volume and the relationship we've built. We also have unique financing options that are available that we've also negotiated with different banks and credit unions. So you can use whatever lender you want to. Traditionally you need 20% down with a conventional lender to buy, but we also have local credit unions that will offer 5% down investor loans. And I know I'll get a ton of questions about this. I'm happy to go through this loan option. You still have to qualify for this loan. It's a portfolio loan, meaning these credit unions hold these loans in-house. They don't sell them. There's not Fannie Mae, Freddie Mac loans. You still have to qualify. You need to be, financeable and have good credit. But if you qualify, they will finance you up to 5 investment properties with only 5% down. There's no PMI, private mortgage insurance. There's no prepayment penalty. Remember, on a conventional loan, if you put less than 20% down, even for a primary residence, you have to pay mortgage insurance, PMI, right? We have lenders that will do 5% down on up to 5 investment properties. They don't lend in all states, but they lend in most of them. Now, here's how the 0% down works. And you don't have to do this, right? You can buy properties with 10, 20% down if that makes sense for you. We're here to help guide you through the right option. But if you're getting 5 to 10% back on a new construction property and you're using a portfolio loan from a local credit union, these are 30-year loans. They do have a 10-year term. And the interest rate's going to be higher than if you're putting 20% down. Just acknowledge that, there's probably 7 to 9% is the interest rate depending, because it's a bigger risk to the lender, right? As they have a higher loan to values, they're lending more money. It's more risk to them. So naturally they have a higher interest rate. But if we're giving you 5 to 10% back on a new construction A-class property and you're buying it with 5% down, then that 5% back to you, cash in the pocket, can cover your down payment, can cover your closing costs, and in some cases even pay you to own a new construction property with zero money down. So it's matching this unique 5% down loan option with a property that we're giving you 5 to 10% back on, and essentially you're into the property for possibly no money down, and you're getting, in some cases, actually, paid to buy that property. Here's a caveat. Naresh mentioned this previously. If you have a 95% loan on a property, it not only does it have a higher interest rate, but it also has the loan payments just higher, right? Because you have a 95% loan instead of an 80% loan. So what that means is your loan payment's higher. You may not be positive cash flow on these deals. And you just need to evaluate that. This is where it ties into the tax side. And I can go off into a tangent here as well. I'll turn over to Naresh first, but we have a lot of people right now that we're working with. They just want to maximize tax benefits. They want to do the accelerated depreciation. They want to do the cost seg, where you can save up to 30% of the purchase price offset against your W-2 income. I will talk about that, but let me just cover the rest of this. And so, the property may not be positive cash flow if you have a 95% loan. Now, you don't have to put 5% down. You can put 7% down, 8% down to be able to have better cash flow. Or maybe you look at a Midwestern property that has a little bit better rent to price ratio and a little bit better cash flow, where you can still buy property with little to no money down, and you might have a positive cash flow or break even property here. But this can be carved out however you want it to be. It's a unique loan option matched with builder incentives that really provide a really unique opportunity for you to make big moves in your real estate portfolio. I think the one last thing I'll say, Naresh, is that understanding if you're going to buy this strategy or use this where you're, buying new construction, because you can buy up to 5 investment properties with this portfolio loan. So in theory, if you choose the right inventory, you could buy 5 new construction properties where you have no money really into the deals at the end of the day. That causes a huge tax benefit. You need to think about the exit strategy. Most of our investors are holding properties 4 to 6 years because the properties appreciate, the tenant's paying the loan down, just as Naresh talks about Keith's 5 ways you get paid. You're building equity over time. So maybe it makes sense if you do have a negatively cash flowing property within 3 to 4 years, cash out, refinance that property because you have equity in it, or just do a refinance and lower the interest rate, or put a conventional loan in place that has a significantly lower interest rate. So that's where most people are looking to use this strategy over the course of 3 to 6 years. Property management, turnkey in general, guys, we have property management teams that we vetted and likely personally used in all these locations. Most of them handle long-term rentals because that's what we focus on. That's your bread and butter real estate. So management is in place. They're hyper local to each location, and we vetted them, and they do a good job. You don't have to use them. Most people do because they're in place. But you can choose your own management team, or you can self-manage as well. The benefit with going potentially with one of our managerial teams, if you want to be more hands-off, if you're not local, and you don't want to self-manage, that's a great option. And same thing, we've negotiated lower fees because of the volume play with us, because we bring a lot of business. Typical standard management fee is 10% across the board. You'll often see 6 to 10% on management. And as you grow your portfolio, you can even negotiate lower than that, even though we've already negotiated a lower than typical fee for you, being part of our community. The part of the incentives, some of these builders are even paying for covering management for 1 to 3 years, as Naresh said in the beginning. So it's quite possible you could even have 0% management for 1 to 3 years, which is a really cool incentive. The management, how we select them, I I won't go into that in detail for time purposes, but I will say that these are top performing managerial teams that perform well. They put, as Naresh put on here, their average rental increase year per year is 5 to 6%, which is double the national average. So Alabama, for example, their average is 6% per year. That means your rent is going up, your mortgage isn't going up, and likely your expenses aren't either, because on a new construction you should have very minimal expenses, but your rent is going up 6% on average per year. That means your cash flow is increasing year after year. Even with a negatively cash flowing property, there's a period of time where if you're doing 5% down, you may have negative cash flow, where you should be break even and then positive cash flow over like a 3 to 5 year period. How self-management works. So if you choose to self-manage, because you certainly can, whether it's a long-term rental or a short-term rental. What we work with investors on, for those that are not real estate professionals, meaning you don't have over 750 hours of real estate experience, you have a W-2 job that you earn majority of your income, you don't have a spouse that could possibly qualify as RE Pro, you say you're both working, you're not married. If you can't qualify for real estate professional status for one reason or another, one way you still can take accelerated depreciation this year is by self-managing your short-term rental. That means you could buy a $300,000 property, you put some furnishing in it, which is an additional cost, but also additional tax benefit. And you're the one you have to do this yourself, but we have a cheat sheet for you. Like, here's your furnishing team, here's your thing. Like, you just got to go through the steps of doing it. Here's how you list it on VRBO and Airbnb and all the things. We'll help you through that. But by self-managing, you can still take accelerated depreciation. If you've never bought a property before, you can be because it's considered in the eyes of the IRS as an active business. It really is. It's like hospitality versus a long-term rental. You can self-manage a short-term rental and still take the accelerated depreciation and offset it against your active income. So if this is your first property you've bought and you're going to self-manage for this year, this year's the only year that matters, the year that you put it into service. So if you buy a $300,000 property and you self-manage it, and you have some short-term rental activity, that means you can do that accelerated depreciation. So again, on a $300,000 property, we usually see cost segregation studies come in around 30%. So 30% of $300,000 is $100K. And I'm using rough math on this. This year we're at 60% bonus depreciation. Next year it goes to 40, and it's a step down until it's phased out. That's why it's important. Like, this year has better tax advantages than next year. It probably makes sense to buy now versus the beginning of the year, because you can count against 2024 income. But on a $300,000 house, 30%, $100K, 60% bonus depreciation is $60K. That means if you buy a $300,000 property and you short-term manage it yourself this year, you could likely get around a $60,000 tax deduction this year, right? And that's against your active income. You earn $120,000, all of a sudden you've cut your tax bill in half just by buying through that. And again, if you buy that property with 5% down, where we cover the 5% for you or more, so you're into the property for zero money down, you literally can create a $60,000 tax deduction with no money down. That's how powerful this stuff is. But you have to own it this year. And if you don't want to self-manage it forever, you don't have to. The only year that matters that you self-manage is this year. Next year in 2025, January 1st, you can turn it over to property management and have them manage it. You can operate it as a long-term rental at that point in time. It doesn't matter. It's about the year that you put it into service.
Yeah, I also say they say you have to run it yourself. They don't say you have to run it well, right? And also, like Zach was saying, it's about buying it now whenever it's 60%. That does not mean, let's pretend that you don't want to do a short-term rental, but you're working your way up to being a real estate professional, and hey, in 3, 4, 5 years, I'm going to be a real estate professional. You can cost seg from the past. Like, I'm doing a cost seg this year on properties that I bought in 2019 and 2020. So I'm getting the 100%, or maybe it was 2020 and 2021, but I'm getting the 100% bonus depreciation this year because I bought it in a year where it was 100%. So
That's a gold nugget. If you guys have properties you currently own and you haven't done accelerated depreciation, like Adam said, it's a step down. Last year was at 80%. 2 years ago it was at 100%. So if you bought a property 2 years ago and you haven't done accelerated depreciation, you can still do that. You can file it. You can run the cost seg this year, and you don't even have to do the cost seg. It has to be done before you file taxes. You turn it over to your CPA. But if you bought a property 2 years ago on that same $300,000 property, you get to take a $100,000 deduction possibly instead of 60. But next year it goes to 40, and the year after that goes to 20. So that's why there's time sensitivity around making big tax impacts owning property this year. Again, it takes on average 45 to 60 days to go through and get pre-approved for the loan, to identify a property, to close it.
Thanks for watching. Subscribe to HoltonWiseTV for more financial information, education, and entertainment.